Hello, today we're gonna talk about chapter 3, adjusting entries, and the third type for today is accrued expense. Now, adjusting entries involve no cash. We record the adjusting entries at the end of the period. And we have 4 types of adjusting entries. Deferred expense, it means I paid in advance before it's incurred. Deferred revenue, it means I received an advance before it's earned. Accrued expense, it means the expense is incurred, it's used, but I did not pay yet. Accrued revenue, it means it's earned, I provided the service, but I did not receive the money yet. So today we're gonna talk about accrued expense. So the adjusting entry for deferred expense will be expense on the debit, asset account will go down on the credit side. Deferred revenue, liabilities decreasing on the debit side to revenue on the credit side. I need to decrease the unearned revenue here, as we mentioned in the previous video. Now, accrued expense, I need to debit an expense account, and the credit it's payable. I need to pay it later, so I need to increase my liabilities. And accrued revenues, I need to credit a revenue account, and I need to increase an asset account on the debit side, which is receivable, to be received later. Accrued expense. Accrued expenses are expenses a business has incurred but has not yet paid. I did not pay them yet. Examples are salaries, interest, and utilities. Smart Touch Learning pays its employee a monthly salary of $2,400, half on the 15th and half on the first day of the next month. So the monthly salary is $2,400. Half of it, which is $1,200, will be paid on the 15th of the same month, and the other half, which is $1,200, will be paid on the first day of the next month. Now, let's understand this part. Now, the employee will do his work, he's gonna work, then I'm gonna pay him. So, for the month of December, he's gonna work from December 1 until December 15, and I'm gonna pay him half of the 2,400, so I'm gonna pay him 1,200. Then he's gonna work from the 15th until 31, and I'm gonna pay him on the first day of the next month, which is January. I'm gonna pay him on January. So now I need to record the adjusting entry at December 31st. So for me, it's incurred. The salaries, it's incurred. Why? Because he worked from 15 until 31st. He worked from December 15th until 31st. Okay, but I did not pay him. I'm gonna pay him when? Tomorrow, on January 1st. So it's gonna be payable. Since he did his work, so it's incurred. So I need to debit an expense account. But I did not pay yet, so I will record a liability account on the credit side. It's payable. On December 31st, Smart Touch Learning owes its employee $1,200, half of the $2,400, which won't be paid until January 1st. I'm gonna pay it tomorrow, so it's accurate. That's why I need to debit an expense account to decrease my equity, and I need to increase the liability account, which is payable. I did not pay yet. I'm gonna pay tomorrow on January 1st. Now this is another example on interest. Smart Touch Learning borrows $60,000 on December 1 to purchase a building. Okay? As of December 31st, Smart Touch Learning incurs $100 of interest on the note. Now, Borrows means he borrowed money from the bank, for example, to purchase a building. Okay, so his entry will be building to notes payable. Because I borrowed 60,000, this is notes payable. Okay, which means it's a promissory note that I'm gonna pay the 60,000 on a certain date later on, maybe after 1 year, 2 years, 5 years, it depends, plus interest. So this is the principal. 60,000 is the principal amount. I need to pay the 60,000 plus interest on a certain date. Okay, but since it's interest, I need to accrue interest over time. Okay, so here he's saying that 100 is per month, because he said from December 1 until December 31 the interest incurred. Incurred means it's an expense, it's used. Okay, I use the money, so I need to incur the expense. It's incurred. Okay, so I need to debit an expense account to decrease my equity, but I did not pay yet. I'm gonna pay in the future. I'm gonna pay 60,000 plus interest. Okay, so it's gonna be payable. I need to increase my liabilities only for the $100. Here the 100 it's given, but normally we multiply the principal amount by the interest rate by the fraction. Okay, you need to count how many months. So for here it's only 1 month. The principal in this question is the 60,000. The rate it's not given. And the total amount of interest incurred for this month is 100. Okay? Thank you for watching. If you have any question, please leave a comment. Please like, share and subscribe.